Okay, tax students, this is part 4 of our video lecture for chapter 2. We're going to cover taxability of life insurance and something related called annuities, and some, not all, retirement income. So here, regarding life insurance, the general rule is that whoever receives the insurance proceeds when the person passes away, that proceeds is tax-free, or we use the word here in chapter 2, excludable income. Of course, the person passing away is not going to collect it, right? It's their beneficiaries that collect the life insurance proceeds. Again, the general rule is life insurance proceeds are tax-free. Now, maybe the person that's insured is terminally ill, and for hardship purposes, maybe the insurance company will let the insured person take out money early, collect proceeds early to help with the care and health costs of that dying insured person. That's also probably a tax-free situation. Our textbook doesn't talk about generally interest being collected, but if the beneficiary receives the proceeds over a longer period of time, not just a lump sum amount, yeah, but spreads it across multiple years, then the insurance company is going to pay extra, and that extra amount will be taxable interest or will be what we call a taxable annuity. But let's go back again and talk about insurance here. Let me diagram it out. So here is our life insurance company, and we have our insured person, yeah, covered with that life insurance. And over their life or a certain period of time, they're paying for this life insurance. The cost of the life insurance is called a premium. And when our insured person passes away, the proceeds don't go to the insured. Again, this person has passed away. They go to the beneficiary of that insured person. And again, the general rule is that it's tax-free. Now, when we pay life insurance premiums, sometimes the cost gets lower. Sometimes the life insurance company will reduce this premium amount because this life insurance is earning dividends for that insured person. Yeah, dividends. And the dividends can be used to reduce the cost of the premium, or the dividends can actually be paid back to the insured. Insurance dividends are generally tax-free. Or maybe the insurance dividends are reinvested with the insurance company, like a savings account earning interest. Now, if the dividends start to earn money with the insurance company, that's going to generate interest income. Interest income is taxable to the insured person. Yeah, and they're going to issue out, we'll learn in a couple of videos from now, a form called a 1099 INT to report the interest to the taxpayer. Okay? The interest may be even reinvested, but it's still going to be taxable to the insured person. Whenever you see dividend from a life insurance, the general rule is it's tax-free. Whenever you see interest being paid by the insurance company, that's taxable. And again, if the insured person passes away, this proceeds will be paid to the beneficiary, either as a lump sum amount or if paid over multiple years, the extra is considered to be either interest income or a partially taxable annuity, which is the next topic here in our slideshow. Annuities are also purchased by the um, insured person, the annuitant. But you don't wait till the person passes away to collect an annuity. It's usually paid during their lifetime. So in the case of insurance, the insurance company wants the insured person to live a long time, yeah? So they don't have to pay out the amount for a while. But in the case of an annuity, if it's paid over the lifetime, the interest of the insurance company is that the person has a short life. Let's illustrate an annuity. Okay, this is life insurance here, yeah? When the person dies, the proceeds goes to the beneficiary. So let's talk about an annuity. Still working with a life insurance company, and we now have not a insured, but an annuitant who pays a premium. This premium could be just one big lump sum amount, or could be many payments over the lifetime or the working life of the annuitant. But then, after a certain point, probably at retirement, they're going to start paying an annuity to our annuitant. Could be either monthly or could be an annual payment. And the key thing here is, was this premium deductible, or was it not, or was this premium already paid taxes on, or wasn't paid, no taxes paid on? If you already paid taxes on this premium money, then part of this annuity is going to be tax free up to the amount of the premiums that were paid, and the rest is going to be taxable. So we need to go through a formula, if this is the case, how much of it is tax free and how much of it is taxable. And our textbook talks about two different methods to calculate that tax free and taxable amount. The general rule is that we use the method called the simplified method, since most annuities now will start after this date here. Yeah? Typically, also, we're looking at the annuity being paid over the life of the annuitant. Or maybe if the annuity continues with another person, we need to look at the total lives of the annuitant. And here we're told we need to use a simplified method worksheet. So I have that linked in the resources folder for our chapter. But here is the worksheet, simplified method. This is in the instructions to the 1040 form. So the taxpayer is going to get this form 1099-R from the insurance company showing them how much annuity was paid. So here's the 1099 form. Here's the insurance company. Here's our taxpayer annuitant. And here's the total amount they received from the insurance company for the year. And most times they'll tell you how much of that total distribution is taxable. So we don't have to worry about going through that calculation on the worksheet. All we do is take this gross amount and the taxable amount and report it on our 1040 form. So we've already learned about wage income in the previous videos, and we're going to learn about interest and dividend incomes in a coming video. We'll save IRA income for a future chapter. What we're covering in this chapter is something called pension or employer retirement plans and annuities. We'll see Social Security benefits reported in another video for this chapter. But we will take that gross amount the insurance company paid as an annuity, put it here in box 5A, and the taxable amount in box 5B, and add it to all the other taxable income to get the total income here. That's assuming these two amounts are given to us, yeah, the gross distribution and taxable. But if the company doesn't fill in the taxable amount, they'll probably will check off this box. The taxable amount cannot be figured out, not determined. So now we gotta use that worksheet this simplified method worksheet, and we put in the total distribution here in box 1, and the date here, we start collecting the annuity. And from that point on, we'll try to figure out how much of the cost is going to be tax-free that we get back. Well, here they're asking for the cost. Yeah, the cost may be reported to the taxpayer on the Form 1099 here in this box 5. Okay, it may show, it may possibly may not, but hopefully the cost will be here. And they rewrite it over here. And you're going to recover this cost over the lifetime of the employee, reducing each year's gross distribution. But how long is the taxpayer going to live? Well, they kind of simplify it. Yeah, they simplify things for you by telling you to look at this table 1 or this table 2 that's at the bottom of this worksheet. If the annuity is just based upon one person, the annuitant's life, you look up the age over here when the annuity starts to be collected for the first time. Yeah. So if you're 55 or under, well, let's go 56 through 60 years old when you start collecting annuity, you're expected to live another 260, well, here, 310 months because we're collecting it after this date here. Yeah. This is your life expectancy here, 310 more months. So we would put that over here. Now, if your annuity continues, so where your spouse or some other beneficiary collects it over their lifetime if you pass away, then you have to add up both of your ages at the time the annuity starts. And here in the right-hand column would be the amount of months till the second person passes away. And you divide those months into the cost to figure out what's the amount of costs you collect tax-free each month. And eventually you figure out the amount that's non-taxable for the year. So you take the amount you collect for the year and you minus out the amount that you get to recover tax-free to get the amount that is taxable. Keeping in mind, you cannot recover tax-free more than that original cost. So really the rest of the lines here kind of keep track of those amounts you collected tax-free in past years. And again, making sure you're not going to deduct more than the original costs. So gross amount received and taxable amount. Back here on the 1040 form, the gross amount received and then the taxable amount. Here the difference would be the tax-free recovery of the costs. Again, that's an annuity. Now, maybe the annuity is related to an employer retirement plan, either a pension or profit sharing, or you hear the terms 401k or 403b. So let's kind of analyze this. Well, before we look at employer retirement plan, let's look at the second method of calculating how much of the annuity is taxable. Again, this is the main way people use the simplified method. And if you cannot use a simplified method, most people use simplified method, but if you cannot, maybe because the annuity is not going to last for a lifetime. Maybe it's set for a certain number of years that's shorter than a lifetime. Then you have to use a calculation called a general rule. So here's the formula for the general rule. You have this fraction over here, and in the numerator of the fraction is the total cost that you put into the annuity contract that you're going to recover tax-free over that period of time. And then here in the denominator is the amount you expect to collect over your period or lifetime in the annuity. So here's the annual amount. You multiply it by the time period. In this case, they're using life expectancy to get the total you expect to collect. So this fraction represents how much of every dollar you receive that's going to be tax-free or excluded. And we multiply this fractional percentage by the amount he received during the year. So here's an example. We have Din, who puts into the um, annuity, here they call it a retirement account, $750,000. That's Din's cost. Din's already paid taxes on this. If Din didn't pay taxes on this, everything received would be taxable. Okay, but he didn't pay taxes on this contribution. So he's going to get it back tax-free over his lifetime or whatever years he's going to collect the annuity. Here's the amount that he's collecting every month, and he's going to collect it over 19 years. Again, it could be his lifetime based upon not the simplified method, but another table called a mortality table. 19 years. So 4,800 per month times 12 months a year times 19 years. That's the total right here that he expects to collect over his lifetime. And here's how much he's going to collect back tax-free. This percentage here, for every dollar, he collects 68.5 cents tax-free. So in the year, this year, we multiply 48 times 12. Here it shows divide, but this should be multiply, yeah, not divide by 12 months. Yeah, this is not divide, but should be multiply by 12 months. To get the total amount he collected during the year, here's the percentage tax-free, or here is the amount that's non-taxable. So let me figure out the amount he collected. Where's my calculator? Let me bring in my calculator here. So 4,800 per month times 12 months. That's not correct. 4,800 times 12 months. He's collecting 57,600 a year, of which what's tax-free is 68.5%, or this 39,456. So if I minus out 39,456, the remainder is what's taxable. Again, he collected 57,600, and here's what's taxable. So on the 1040 form, you put in here the total he collected during the year, and here in the right-hand column, the amount that's taxable. You don't show the amount excludable, but that's the difference between the two amounts here. Yeah? Okay, so that's the general method. But for most people, they're going to be using not this general method, but the simplified method. And one more time, you would do that using the worksheet here that's in the instructions to the 1040 form. Now, annuity may be related to an employer retirement plan. So let's go through another illustration again. So let's have our employer paying a salary or wage to our employee. And the employer has a retirement plan, like a 401k plan that you hear a lot when you look at job advertisements. Good employers will contribute into the plan. Yeah? Again, we call this contributions to save for the employee's retirement. Most times, 401k plans will allow also the employee to take out of their paycheck and also contribute into the retirement plan. And the nice thing about this is that it's going to reduce the taxable wage or salary for the year. Okay? It's going to go down, saving taxes now. In the meantime, these contributions are going to be increasing in value because the 401k plan is investing, let's say, in the stock market or real estate or so forth. So the balance in here is going to increase over the working life of the employee. And when the employee retires, they're going to take out distributions. And the question is now, how much of it is going to be taxable? If the money being put in is coming from the employer and the contributions made by the employee is reducing their taxable salary or wage during their work life, all of this distributions is going to be taxable. So when the employee retires, they're going to get a 1099 form again, and the total amount over here, gross distributions for the year, is going to be all taxable. No question, yeah? The same amount. Also, if it's all taxable, the general rule is that you don't put anything over here for the total distribution because the taxable amount is going to be all over here, same as the total distribution. Yeah, so you may see this 5A blank and the 5B, you'll see a dollar amount. That means the total amount is taxable. But it is possible in certain situations that the amount put in by the employee is going to be taxed. It's not going to reduce the taxable salary wage during the work life. We call this post-tax distribution. You already pay tax on this amount here. And that means when you make the distribution to the employee when they retire, this will be tax-free. Again, when the employee retires, yeah? And then the rest is going to be taxable. So now again, we got to figure out when distribution is made, how much of it is tax-free and how much of it is taxable. And again, we may need to fill out this simplified method worksheet. The amount the employee got for the year, how much of it was already taxed over here, their expected life, and how much of it is going to be used up tax-free each year. Keeping in mind, you cannot get tax-free more than the total you put in. This amount here is probably going to be reported on their 1099 form, again over here. Okay, so let me kind of summarize this by using an IRS publication. This is in one of the training materials for IRS volunteers. So if the employee, I cannot write on the screen, if the employee puts nothing into the retirement plan, here it says no. That means the employer is putting money into the plan. The plan is also earning profits over the lifetime of the employee. And now when the employee takes out money, everything is going to be taxable. But if the employee puts in money also with the employer, and the employee doesn't pay taxes on that contribution, here they call it before tax or pre-tax, then when the employee retires, still everything is taxable coming out of the employee plan. We don't have to do that simplified calculation. But again, if the employee puts in money and the employer puts in money, but the employee's contribution, they already paid taxes on it. This amount put in is going to be coming back to them tax-free. So part of it is going to be taxable and part of it is going to be tax-free. Now we got to use that simplified method if you don't already see the calculation or the amounts over here for you, yeah? Again, this box will be checked off if they don't have the amount taxable. Here's the amount they put in that's going to be coming back tax-free over their lifetime. Okay, and one more situation. If the type of plan is called a Roth, typically a Roth means when you put in money, it's going to be non-deductible here after tax. You're going to pay taxes on it. But then the benefit of a Roth type plan is usually everything is tax-free. Okay, we'll talk about Roth type retirement plans in a future video. Okay, I think that's all I want to cover in this one. So go ahead and continue into the next video when we talk about Social Security benefits.